Ladies and gentlemen, get ready as we dive into the story on why China's housing market crash is not over. We have just got new news and new data that China is facing massive defaults. We'll uncover the shocking risk of China's property developer bankruptcies and the unfinished properties that have shaken the nation. We're going to explore the economic impact this is going to have as the country faces a funding crisis, which could lead to one of the most significant financial events of our lifetime. So let's unravel what's really been happening with China's economy, and then we're going to go over what this means for you and me. So this story all began with Evergrande, or some people pronounce Evergrande, when they faced $300 billion in defaults. This caused contagion and ripple effects through the whole Chinese economy and financial system. But many people have now said that this crisis is over and everything has been contained. China started pumping money back into these projects, into these developers. They started loosening lending standards because there started to be massive protests, massive bank runs, and mortgage boycotts. But this has had huge consequences. By December 2022, we had a huge increase in bad loans. And these bad loans normally make up maybe 10% at most of loans in the property sector, but this increased to a massive amount of 29%. This has led the International Monetary Fund to issue a huge warning to China to get its real estate market in check, get its loans and balances in check, because the housing market and the property market in China accounts for 29% of GDP. Now again, you may be thinking, if you're watching the US, Australia, Canada, UK, etc., why should we care? Well, the reason why we should care is because China is the second biggest economy in the world, and it is a factory for the world. So whatever happens to China is going to affect the rest of the world. So we know what caused the crisis. We know it's not over, but we did just get very new critical information to say that the property market chaos is about to begin again. So look at this, everyone. 10 billion property bond defaults are just around the corner. And China's local governments are tightening their oversight of developers' pre-sale process. What? I thought the crisis was over. I thought there was no more defaults coming. Well, let's keep reading. Listen to this. Guangzhou-based KWG Group Holdings Ltd, one of the few developers that obtained a state guarantee for its latest yuan note issue, said it had failed to make 119 million redemption payment, thus triggering a cross default of all its $4 billion bond. Meanwhile, notes issued by Powerlong Real Estate Holdings Ltd have plunged in recent days as traders see little chance of Shanghai-based builder repaying $15.9 million coupon due later this month. But they're not the only one in trouble. The high yield dollar bond market will witness another 10.1 billion of defaults this year after a record 63.7 billion in 2022. So I'll move myself, and we can see with this chart here that bond defaults absolutely skyrocketed in 2022, but they're about to start ticking up again. This is according to estimates from HSBC Holdings. And the bank also sees credit risk lingering for China's SCE Group Holdings Ltd and Central Real Estate Ltd. Now you may be wondering, why is this happening? Well, the reason why this is happening is very, very simple, everyone. Political stability. This is the only thing China puts before prosperity and economic growth. Because again, we all saw the huge bank runs that happened in China last year. We all saw the huge protests, the mortgage boycotts, and so a lot of local governments are very, very worried this is going to happen again. So they're clamping down on developers and their pre-sale process. So local governments have learned a lesson. They now have political incentives to tighten the scrutiny of the pre-sales process. To them, consumer protection and therefore social stability is a lot more important than whether developers can repay their dollar bonds or not. And we can see this chart here again, everyone. Funding stress. New worries are emerging that local governments are tightening scrutiny over pre-sales cash escrow accounts again. So these accounts are normally where developers park all their money, and we all knew that some of these developers in China, they were taking that money and they're putting it in other investments. We can see here this stress hit a record high in 2022 and then fell, but is now starting to tick up again. They warn cutting off developers' access to escrow accounts inevitably sends many into distress. Last year, consumer deposits and advance payments accounted for about 1/3 of builders' funding, while bank loans took up around 12%. Tightening at the local government level would already deal a fatal blow to already vulnerable builders. Now, this isn't just happening in China, everyone. We're seeing huge stress for the construction industry in the US, especially with a lot of issues with rising inflation, labor shortages. A lot of times they went to build homes, they fixed at a certain price, but then all of a sudden all the material costs skyrocketed and they're building these homes at a loss. But the way the development process works in China is a little bit different. they put a huge upfront payment, a down payment. Many times they're paying 10, 20%. And also they actually start paying their mortgage before the property's even built, sometimes even 4 or 5 years in advance. Now, the reason the Chinese do this is a cultural thing as well. They think it's bad luck to buy a property. They don't want to inherit. They don't want to inherit the previous owner's bad luck. And also that's another reason why they normally just buy these shell apartments and try to flip them for a profit. So we are going to see more massive defaults for the China's property market, but that's not the only issue for China. We just got some more breaking news from the latest G7 meeting of the global top 7 countries and the countries that have the most economic influence, and they're sending big warnings to China. So look at this, everyone. G7 issues strongest condemnation of China as it intensifies response to Beijing. Now, the two biggest concerns by the G7 nations are one, economic coercion by China, and second, the militarization of the South China Sea. The G7 issued its strongest condemnation of China as the world's most advanced economy stepped up their response to what they call rising military and economic scrutiny threats posed by Beijing. Now, we are at a massive pivotal point in history right now. Right now, the US is number one. They have global influence and global supremacy. But China is second in charge, and they're wanting to take dominance. And just like the US, they're trying to spread their military dominance as well. Now, the reason why this is so important for the macroeconomic picture is if there's going to be more trade tensions with China, that's going to lead to higher inflation for the US. That's going to lead to higher interest rates and slower growth. The G7 members said they were seriously concerned about events in the East and the South China Seas and strongly opposed any unilateral attempts to change the status quo by force or coercion. They also called for a peaceful solution to tensions across the Taiwan Strait. The statement marks the strongest criticism of Beijing by the G7 at the 3-day summit in Hiroshima. The US and its democratic allies are seeking to project a unified front in the face of global division caused by the war in Ukraine, the US-China dispute, and climate change and expansion of artificial intelligence. So the G7 are condemning China for all these issues, but there's one issue they didn't address, and something massive China is doing. They're sending many countries to the brink of bankruptcy. Look at this, everyone. China's loan is pushing world's poorest countries to the brink of collapse. So foreign cash reserves have dropped in 10 of the dozen countries in AP's analysts, down an average 25% in just 1 year. And not only this, but also a strengthening dollar since the pandemic has meant that a lot of these countries have to use more and more of their currency to repay their loans that have been priced in dollars. They have plunged more than 50% in Pakistan and the Republic of Congo. Without a bailout, several countries have only months left of foreign cash to pay for food, fuel, and other essential imports. Mongolia has 8 months left. Pakistan and Ethiopia have about 2. So this is something I don't hear anybody talking about, everyone. We're going to see multiple countries this year default, and hey, even the US government might default if they're going to get their debt ceiling talks resolved. And unfortunately, Pakistan and the Republic of Congo are facing the biggest issue with their reserves down 50%. Now, you may be thinking, well, these countries have always had issues with foreign currency reserve shortages, high inflation, spike in unemployment, and also hunger, but they haven't experienced issues this severe. But what many people don't know is China has much more loans in hidden debt and shadow debt than the world realizes. So the hunt began in 2011 when a top World Bank economist asked Parks to take over the job of looking into Chinese loans. Within months, using online data mining techniques, Parks and few researchers began uncovering hundreds of loans the World Bank had not known about. And you're going to be shocked with what they found. In 2011, a decade after Parks and his team began their hunt, they gathered enough information for a blockbuster finding. At least $385 billion of hidden and unreported Chinese debt in 88 countries, and many of those countries were in far worse shape than anyone knew. And you better believe it is much higher now. Another A data report around the same time suggested that many Chinese loans go to projects in areas of countries favored by powerful politicians and frequently right before key elections. And some of these things built made little economic sense and were riddled with problems. Meanwhile, China's taken on a new kind of hidden lending that has added to the confusion and distrust. Parks and others found that China's central bank has effectively been lending tens of billions of dollars through what appears as ordinary foreign currency exchanges. But what exactly are these foreign currency exchanges? Well, they're called swaps, and that allows currencies to essentially borrow more widely, use currencies like the US dollar to plug temporary shortages in foreign currency reserves. They're intended for liquidity purposes, not to build things and last only for months. But China swaps mimic loans by lasting years and charging higher than normal interest rates. But more importantly, these don't show up on countries' balance sheets as loans, making the country's debt seem much lower than it really is. So everyone, I know you're thinking, what does all this economic jargon mean for you in simple terms? The reason why this is so important is because the world over the past 2 decades has relied on China's boom to fuel economic growth. But China's growth is slowing, and it's slowing rapidly, and there is also still huge risk for its property market, which again accounts for 25% of China's GDP, which is going to have big consequences and could cause a financial crisis in China that would ripple throughout the whole world, just like what happened in the US in 2008. People think, well, if there's a financial crisis in China, it won't affect me. Yes, it will, people. Just like the 2008 financial crisis affected everyone, so will a financial crisis in China. So everyone, we have to continue to monitor this situation, but what do you think about this? Let me know down below. Now, again, if you wanted to get access to my free newsletter, just click the link in the description, get up to date on all the reports that I do on all this financial news, my research and notes. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I hope you're enjoying all this content I'm pumping out. I want this to be the place where you get the story first and you also get the most research. Thanks for watching. I'll see you all in the next video.